Okay, we know what a prepaid revenue is. Let's look at how we might record one. In the previous example, we looked at a business that receives orders from customers up front, they get the money, and then they go and make them tables. So what we said was in May, a customer ordered 3 tables, let's say on the 15th, and paid up front. The selling price is $100 each plus GST, and the cost price is $40 each plus GST. So we are Fancy Furniture. The customer is going to prepay us in May $300 plus GST, so that goes to us. And then, unlike most transactions where now we give them the product, we're actually going to go away and make the tables. So there's going to be a bit of a lag between when we get this money and when we actually earn this revenue. So what we'd say is when we get the money, we're going to call it $300 plus $30 GST. We've got cash, so that'd be a debit. And then in the previous video, we learned that GST goes up as per usual. But what's different is we don't call the $300 a revenue. What we're going to do is call it a liability called prepaid revenue. So we put it in there. So let's say on balance day, the 30th of June, we're trying to figure out our profit and figure out all of our expenses and so on. Let's say we've actually earned, we made 2 tables and earned the revenue for 2 of the tables. So they've gone to the customer. So the customer's got 2 of the tables which they paid for. We've still got 1 to make though. So I guess what we say is we've earned the 2 tables on the right, so then our revenue earned, but we're still making that 3rd table. So we've still got a liability because that last table is unfinished. So looking at our ledger, we previously said we've got a liability here for $300. But things have now changed. We've actually earned 2 tables worth because the customer's got those. We're still working on 1 table. So what we really should do is decrease this to reflect the revenue that we've earned, because we don't owe 300 now, we only owe 100. So what we'll do is take it out of here and then we send it and call it a revenue over here. And the journal we do that in is the general journal. So the entry we're going to make is a debit to prepaid revenue and a credit to sales. So basically what we're doing is we're transferring out the amount of revenue, prepaid revenue that we've earned, and sending it to the sales revenue ledger. So what would that look like now? Well, we've got our prepaid revenue ledger, which is a liability. We've got a credit of 300 and a debit of 200. So we balance that one because liabilities get balanced. And if I balance that out, I'd end up with a balance going forward of $100, and that makes sense. I'm still working on this last table, so I still have a liability of $100. I have finished 2 tables, so I've earned that revenue. So we said there's going to be a sales revenue of 200. We close that to the profit and loss summary ledger, and that'll just go in our regular profit calculations for the period. Where would this go in all the financial reports? Well, looking at our balance sheet at the end of June, we're still going to have a current liability called prepaid revenue of $100. And then in the income statement, we're going to have the revenue that we've earned, which we'll put under sales of $200.